Imagine trying to pick the best stocks on your own. You'd have to research dozens of companies, track the market every day, and still you might underperform the average investor. That's where index funds come in. A simple, low-cost way to invest in the stock market without having to pick winners and losers yourself. What exactly is an index fund? An index fund is a type of investment fund that tracks a specific market index, like the S&P 500, the NASDAQ 100, or the Nifty 50. Instead of hiring fund managers to decide which stocks to buy or sell, an index fund simply mirrors the performance of that index. For example, if the S&P 500 goes up 10% in a year, the S&P 500 index fund will also rise about 10%, minus a small fee. How does it work? Think of an index fund as a basket of stocks designed to represent an entire segment of the market. When you buy one share of an index fund, you're buying tiny pieces of hundreds of companies at once. So instead of betting on a single company like Apple or Tesla, you're investing in the whole market, which reduces your risk. It's the easiest way to diversify, even with a small amount of money. Why do investors like index funds? 3 main reasons. Low cost. Since index funds are automated and don't need expensive managers, their fees are much lower. Diversification. You instantly own shares in many companies, spreading out your risk. Consistent returns. Over time, most actively managed funds fail to beat the market, while index funds match it, which often means better long-term performance for you. In short, an index fund lets you invest in the entire market, not just individual companies. It's simple, affordable, and one of the smartest long-term strategies for building wealth. So if you want your money to grow without constant effort or stress, index funds might be your best first step into investing.